Welcome to Cotality's Housing Market Update for September 2025. Housing values are blooming ahead of spring, with the National Home Value Index up 0.7% in August. That's the strongest monthly gain since May last year. The growth cycle's been gradually building momentum since the February rate cut, with buyer demand spurred by a lift in borrowing capacity, real wages growth, rising confidence, and what's likely to be a growing sense of urgency as advertised stock levels remain tight. The monthly rise pushed the annual change higher for the second month in a row to 4.1%. While housing values are rising across most regions, the pace of growth remains modest relative to recent upswings. During the pandemic, the monthly change in the national index peaked at 3.1% in March of 2021, and the upswing commencing in early 2023 climbed quite rapidly, reaching a 1.3% high in May of 2023. It'd be surprising if the monthly rate of change rose anywhere near these earlier cyclical peaks, given how stretched housing affordability has become. What's more likely is that home values will rise at a more sustainable pace, with demand dampened by affordability constraints, more normal rates of population growth, and cautious lending policy. The growth trend remains geographically broad-based, with almost every region recording a rise in values over the month. Tasmania remains the exception, with Hobart values down 0.2% over the month. The mid-sized capitals are once again leading the growth trend, with Brisbane up 1.2%, Perth 1.1% higher, and Adelaide not far behind with a 0.9% lift in values. Darwin's also recording a solid gain, with a 1% rise in August, taking values 10.8% higher through the first 8 months of the year. That's by far the highest year-to-date gain across the capital cities. Stronger housing conditions could be attributed to a clear mismatch between available supply and demonstrated demand. The annual trend in estimated home sales is up 2% on last year, and it's tracking almost 4% above the previous 5-year average. At the same time, advertised supply levels remain about 20% below average for this time of the year. Against this backdrop of low listings and rising demand, vendors are in a strong position as we head into spring. Auction clearance rates rose to 70% in late August, the highest since February last year, and competition amongst sellers is relatively mild amid such low advertised stock levels. As we move through spring, we should see more evidence of an upswing in new listings. A pickup in the flow of stock coming to market will be good news for buyers who generally have limited choice at the moment. Taking a quick look at rental markets, growth in our national rental index picked up to 0.5% in seasonally adjusted terms through August, the largest month-on-month rise since May last year. The re-acceleration in rental growth has been apparent through most of 2025, with the annual change now rising over 2 consecutive months, reaching 4.1% in August. Rental markets remain extremely tight across most regions, with the national vacancy rate at 1.5% in August, which is around record lows. The 5 years prior to 2020 recorded an average vacancy rate of 3.3%, more than double the current level. The re-acceleration in market rents is one to watch considering the large weight allocated to rental prices in the CPI. There's more than a year of lag between rental value estimates and CPI rents paid, but if the uptick in rental growth continues, it could gradually place some upwards pressure on inflation. The broad-based rise in housing values is set to continue into spring, a period where we usually see a seasonal uplift in listings. While a rise in advertised stock levels will test the depth of housing demand, there's a good chance purchasing activity will continue to outpace available supply. Buyer demand is being bolstered by a healthier household sector, where rising sentiment, wages growth is outpacing inflation, and a tight jobs market are key factors. Compared to 2024, when high interest rates and cost of living pressures were straining balance sheets in the housing market, households are now in a much stronger position. Although interest rates are still not at a stimulatory level and cost of living pressures persist, the household sector is on much firmer ground, positively impacting the housing market. Consumer sentiment reached a 3.5-year high in August, supported by lower interest rates and easing cost of living pressures. Historically, consumer sentiment and housing activity have shown a very close relationship. After drawing down on savings accumulated through the pandemic, households are once again managing to accrue savings, with the household saving ratio trending towards pre-pandemic averages in March. While higher savings also imply less consumption, a return to an accrued level of savings should help prospective buyers access the credit necessary for a home purchase. Real wages growth, at 1.3% per annum, is at its highest level since June of 2020, and about 2.5 times higher than the pre-COVID decade average of just 0.5%. Stronger wages growth alongside lower debt servicing costs should help to support purchasing activity and sentiment. The jobs market remains tight, with the unemployment rate holding around the low 4% mark or less since the end of 2021. while the underemployment rate at 5.9% in July is well below the decade average of 7.9%. Such strong labour market conditions are supporting confidence in the ability to prove up loan serviceability. Furthermore, these conditions, along with very low levels of negative equity, are another reason why mortgage defaults remain so low. The expanded home guarantee scheme is another factor set to support housing demand. With unlimited places for first home buyers, no income restrictions, and higher price caps, we expect this stimulus measure to be popular with first home buyers from October 1st. Saving for a deposit is one of the biggest hurdles for accessing home ownership. Saving a 5% deposit rather than a 20% one could shave about 10 years off the time it takes to accrue a deposit in really expensive markets like Sydney. There is a downside to demand-side stimulus policies like this, though. While the scheme is likely to be popular, it doesn't do anything to address the underlying factors that have caused housing to become so unaffordable in the first place. Although the outlook for housing markets is looking increasingly positive, some headwinds remain that will likely keep the rate of growth in check. Stretched affordability is arguably the most significant factor keeping a lid on value growth, but also elevated levels of household debt, a focus on prudent lending standards, and normalizing levels of population growth are all factors that are also likely to keep the rate of growth below recent cyclical highs. It looks like the spring season is going to be a very active one for the housing market. You can keep up to date with all the trends at the insight pages of the Cotality Australia website.